Today, Sam Jacobs. Thanks, Sam, for joining me today.
Thanks for having me, Taylor. I'm excited to be here.
I don't think most folks don't need an introduction, especially in the B2B world, but Sam Jacobs is the CEO and founder of Pavilion. I've been a executive member of Pavilion for over a year now, benefited from a lot. The reason why I wanted to bring Sam on was he did a deep dive into unit economics and how it relates to go to market, how it relates in 2023. And I wanted to bring him on to kind of talk about unit economics. What does it mean for go to market? What does it mean in 2023? And if we have time, he's going to share his screen and kind of go through his thought process, and it's super helpful. So first, Sam, to start us off, what is unit economics, and why does it matter?
Sure. Well, thanks, Taylor, for having me. And a topic near and dear to my heart, and a topic I think more important today, certainly more important today than it was 2 years ago, for sure. So, what are unit economics? Unit economics is simply a phrase that describes the relationship of the money machine in your business between how much you spend to get a customer, how much they pay you back, what it costs you to service them, and how long they stick around. So those four factors drive your unit economics. And what they tell you is effectively, is your go-to-market machine profitable? Does it work? Right? And that's really, really important. It's important not just because you want to know the answer to that question, you want to know if it works or not. And by work, I mean, it's just, are you spending the right amount of money and getting the right amount back? That's just simple business, right? That's just simple business. But why is it more important today than yesterday or 2 years ago? It's more important today because money is much more expensive now. And so there's an interest rate, right? We lived in a world of zero interest rates where asset valuations were being pumped up by central banks of the world, putting more money into the money supply and giving away free money through 0% interest rates, right? And even the Fed was out there purchasing corporate bonds and supporting the economy in that way as well. What happens through quantitative easing? What happens when that happens? That means that the cost of capital falls. And what that means is that it doesn't really matter how much it costs you to acquire your customer. The only real thing that matters is acquiring more customers. And so we come out of a world where it was growth at any cost. And again, the reason that phrase is relevant, growth at any cost, is because there was no cost, or at least the cost was significantly reduced relative to history, when typically there is a cost to taking people's money, and it's either the cost of debt or the cost of equity. So we move to a world where all of a sudden inflation is surging, we raise interest rates, valuations collapse, and now we're in a world that is not about growth at any cost. It's about growth at the right cost. And growth at the right cost is, in a world pre-venture capital and pre-globalized capital, right? Growth at the right cost is so that you can continue to have a business and not go out of business, right? So that's important, right? Make more money than you spend is good for personal finance, and it's good for your company. But but it's also relevant because, okay, well, there might be periods when it's okay to spend more than you make. But you got to have a point of view on what's going to happen in the future. It's not a good idea to spend more than you make forever. You will go out of business. But you might want to spend more than you make today if you have high confidence that tomorrow you're going to make way more. And that's what unit economics helps you. That's the question that unit economics helps you answer, which is, okay, am I spending the right amount? And really, again, this is somewhat, theoretical and qualitative, but that's the beauty of it. The beauty of it is that it is the marriage of finance and quantitative analysis with all of the soft stuff about your customers and whether they like what you're selling, whether they like your product. And really what it's fundamentally telling you, what the unit economic relationships are telling you is, do you have a product that your customers like and are sticking around for? And if you do, are you paying the right amount of money to acquire them? And those things are very, very important. And if that math is wrong, not only might you go out of business, but you might become unfundable. And they're of course closely related, right? The prettiest person at the dance, never always gets asked out and might not need a date. And perhaps the person that is less attractive needs a date. Companies that don't need the money might be offered lots of money, and companies that do need the money might not be offered any at all because the math of their business doesn't work. So again, fundamentally what we're talking about when we're talking about unit economics is four factors, right? Your customer acquisition cost, which is how much money it takes to spend to acquire one customer, how much they pay you back over time, that's your average revenue per customer, then what your margins are, meaning what does it cost you to service the customer, right? It's not free money when somebody buys your subscription. You got to give them stuff. So how much does it cost you to give them that stuff? And then fundamentally, the most important, okay, you're giving them that stuff, they're paying you money. Do they agree? Do they agree that it's valuable? If it's valuable, they'll stick around and they'll keep paying you. And again, unit economics is okay, the amount of money, the difference between what they give you and what it costs you to service them, you use to pay back what it costs to acquire them. And hopefully it's much more than that. So again, it's just simple. It's not complicated, and but it can be intimidating for people that aren't used to working in spreadsheets and aren't used to looking at math. And it feels intimidating to say, are we in a place where we can invest more in the business? The last thing I will say is, again, it might be okay. It is the interconnectedness of these relationships. And what's the point that I'm making? The point that I'm making is if you're in a subscription business and your customers never stick around, that might be okay. That might be okay if you didn't pay anything to get them in the first place. That might be okay. The problem is when you pay too much to get them. That's what we're trying to understand. What's the relationship between how much I'm spending? And of course, what you're spending is not just paid advertising. It's not just billboards on the West Side Highway. It is your head of sales. It is your sales team. It is your sales development reps. It is the insurance that you're paying for your sales development reps. It is the licenses for all of the technology that they might use to get more productive, get more meetings, etc. It is, am I spending the right amount of money to get the right amount of return? Again, straightforward business stuff. Last thing I'll say is, again, in today's world, that math is more urgent. It's more urgent because if you're completely out of alignment, your business may be uninvestable. And that might mean that you are on a path to going out of business. And that's why it's really, really important. You have to understand. And I guess the last point that I'll make, and then ask me questions, Taylor.
Sure.
But the last point is that these are not static states. This is not a point in time and it's true forever. You can come in and out of being investable. You can come in and out of product market fit. You can come in and out of your business being worthy of investment, but then maybe only the right amount of investment. And you can say the business looks good, but it's not good enough for me to pour a ton of money in, but I can pour some money in because it looks good enough to do that. And it's about sizing your bets relative to the strength of your product market fit, which is a way of saying sizing your bets relative to customer satisfaction and delight.
I love that. I love that. And yeah, tying it back into the experience and what is the relationship to the experience the customer gets versus the profitability, and has to be a perfect balance of, if I'm hearing correctly, the business has to make money, but the individual, whoever you're selling to, also has to get a certain amount of value, and balancing that ratio out. Super helpful. Thanks for setting the stage. That's I love the background. I'd love to get into that spreadsheet because I think that'll be great to for us to kind of dive deep into that. And I think as we get into the spreadsheet, I'd love to hear just right off the bat, maybe what areas, what levers on this spreadsheet, as you talk through it, what levers are super important, and as the market has changed, what benchmarks, which we could probably talk 2 hours about benchmarks and the helpfulness of them or not. But I'd love to hear about benchmarks. I think that's also something to consider as if somebody is looking to raise money or is looking to grow, what are some parameters that they should be looking for? Yeah.
Sure. Well, again, let's keep setting the stage. So the first part of the stage is that it's growth. It's not growth at any cost. It's the growth at the right cost. So the levers are, there's a couple levers, right? First thing you see here is total amount of bookings for this given month. What we're looking at is a workbook that we give to members of Pavilion that are taking CRO school. And what we're trying to help them do is to begin to play with the math of the profit and loss statement, of the financial statement, right? So let's take a given period of time. Let's say it's a month. We just booked $65,000. Okay, so one of the lever, and we have 8 new customers. Okay, so first lever is price. That's a lever, right? And there's plenty of situations and there's plenty of worlds where people really, really like your product. They just won't pay you enough for you to build a business around it. And sometimes you want to shout at the world and you want to say, no, we have product market fit. They just won't pay enough. And the answer to that question is, unfortunately, then you do not have product market fit, right? Product market fit is they agree that what you're doing is valuable enough for you to continue to exist as a company. So let's look at if we're charging enough, right? And it's not, because sometimes you say the answer to this is to raise prices. Well, it's only the answer to raise prices if your customers will pay the higher price. If they will not pay the higher price, then again, you might have a beautiful solution, but now it's your job to figure out how to deliver it more cheaply. Okay, so first thing we want to look at is price. What is our average price? Well, it's going to be 65,000 divided by the number of customers we brought in, which you see in that row, and that cell B6 is $8,125. Okay, so basically we're charging 8 grand. Might say a different number on the rate card, but that's fundamentally the price that we're charging because that's what people are paying. Okay, we have a lever there. We can try and charge more. We can try and charge less. What's the second main lever that, and I guess there's kind of two levers, right? There's long-term levers and there's short-term levers. So let's look at short-term levers. The next short-term lever is how much you're paying your sales team, right? And how much you're paying to acquire the customer. And then you really have to understand, and this is work that we have done at Pavilion for our company, right? You have to understand, this is why attribution is so important. Attribution is so important because you have to understand, when I spend that dollar, is that why they're joining? Is that why they're joining? Or are they joining for a different reason? For example, and I talk a lot about, and recently particularly, I've got a new keynote that I'll be giving, at the Ascent conference in San Francisco. We're recording this, on May 17th. So by the time you hear this, it may be too late, but it's called The New World of Revenue Generation. And what is the new world of revenue generation? Put very simply, it's send all your best leads to a very small number of sellers and do not build large sales teams unless you can demonstrate that they can deliver 100% quote attainment. And just so you know, the stats that we see in our poll surveys in Pavilion indicate that most quote attainment's at 30% right now. 30%. So a lever we have, if we're getting any leads at all, a lever we have is have a smaller sales team. Send your leads to 1 or 2 people instead of 10 people. And if you've got 20 people, send it to 4 people. But there's probably a ratio of 5-to-1 unproductive to productive. That's back of the envelope when we're talking about benchmarks. But my experience is that in the aggregate, and that if quote attainment was 20%, it would be exactly 5-to-1. So if general quote attainment's about 30%, then we would say 3-to-1, right? You probably need 1 rep for every 3 that you think you do. That might be possible. Well, I would look at the math for your business, but the next lever would be, this is what you're spending. Now, down here is what we call customer acquisition cost, right? So this is what we're paying our sales team, what we're paying the marketing team, all of the tech that we might use, and then of course any paid acquisition, Google ads, LinkedIn ads, and then of course the most famous dumb investment of all time is your PR agency, sadly, to all of those PR professionals out there, but I've never seen this truly sing when it comes to helping people make money. But nevertheless, this is what this company is spending. Okay, so the next direct short-term thing that you can impact is your customer acquisition cost. Customer acquisition cost is just how much money am I spending to acquire the customer? And then the answer, the question that derives from that is am I sure that every dollar that I spend is the best way to spend that dollar? Could I spend less and still acquire the same number of customers? Or could I spend way less and yes, I'll get smaller number of customers, but it won't be proportional to how much I'm spending. Again, we're not talking about growth at any cost. Growth at any cost when money is free means even if I get 5 customers and I spend $100 and then I spend $200 and I get 6 customers and all of a sudden my math doesn't work, that's still worth it because it's growth at any cost. Any new customer is good and I'll figure it out later. That's not the world we live in. The world we live in is, can I spend more and get proportionally more relative to what I was spending? So first, the next thing we will do on our spreadsheet, and again, if this is a great advertisement really for CRO school, so thank you, Taylor. If you're not a Pavilion member, then sign up for become a member of Pavilion, and you can take CRO school either on demand as a non-executive or live as an executive member. But what we're doing here is calculating customer acquisition costs. Okay, we add in all the money we're paying the sales team, all the tech we're spending, and we're adding in any demand generation investments. Oopsie. Now that's total customer acquisition cost. And of course, what do we want to make sure? Well, it's per customer, right? So we want to divide by 8 so that we can figure out, okay, what are we spending per customer? Okay, so first of all, we're spending $6,421 to acquire the customer. And on average, they're giving us $8,125. Pretty good. That's pretty good. Just off the bat, right? We can say that because this is just to acquire the customer. $6,421 is to acquire the customer. So we acquire them for less than they're paying us back in the first year, and now we go to apply gross margin. So when we talk about gross margin, what is gross margin? When it comes to subscription businesses, gross margin is what is the incremental cost of delivering the service? And that could be customer success, that could be AWS hosting costs because I need to provision a new license for but it is there's a cost associated with having a customer. What is that cost? Okay, we've got the answer here. We have a great software business, very low CS team, not many people, mostly automated. We're using AI to answer all customer support tickets. All good, right? 80% margins, fantastic. So we're going to take 6421, and we're not going to do that. We're going to take 8125, and we're going to multiply it by gross margin, and we're going to get 6,500. Okay, so now, and this is actually the point, right? Which is that this revenue is not free money either, right? We get $8,000. It's going to cost us 20% of that, which is about $1,600, to service the customer. And what's left is what we have to run the business with, and that's 6,500. So now what we're really doing is we're comparing 6,500 to 6,421. And good news, 6,500 is greater than 6,421, which means we spend money to acquire a customer, they immediately cover the cost of what it cost us to acquire them. This tells us that we have a good business. If this number were 12,000, that would be if this number were 3,000, right? If this number were half this number, it would take us 2 periods. If we're measuring in years, 2 years. If we're measuring in months, 2 months. But it would take us 2 periods to be paid back. But this tells us we're paid back in under 1 period. Why is that important? That's important because you can take the money that they use to pay you back and you can funnel it back into growth. You can acquire another customer for 6,421. They pay you back another 6,500, and we keep doing that till this math breaks, and it will break because all channels dry up. But meanwhile, we've got a bunch of customers, and once they're gone away, once we spent this 6,421, as we just looked at, it only costs us $1,600 a year to service them. So this $6,500 is all essentially profit, operating profit or gross margin that we can use to run the rest of the company with. Okay, so then there's 2 big numbers that we look at when we're looking at unit economics. We're looking at payback period and lifetime value of the customer relative to the customer acquisition cost. And again, remember, that lifetime value is basically adding up all of the 6,500s that they pay us for however long they spend with us and comparing it to this 6,421. And so first thing we want to look at is payback period. This means how quickly do we get this money back? And we just talked about how this 6,421, this is cost, and they give us back 6,500, which means in under 1 period, we get our money back. So here's what we're going to do. We're going to divide 6,421 divided by 6,500, and then this is in months because we're going to normalize for months, which means we're going to multiply by 12. And that gives us 11.9. So we're paid back in under a year, and benchmarks, again, when you're paid back in under a year or under 1 period, you're doing great. You're doing really good. And what it's telling you is that you can invest back into the business, that's an investable business. Now let's look at our lifetime value. That's average gross margin, which is this 6,500 divided by this 14%. What does that mean? That means this is the total value of money that you're going to get after you service the customer over the lifetime of their relationship. It's 1 over the churn rate. The inverse of the churn rate is how long they stick around, times this gross margin contribution per customer. Okay, so again, and just think about it this way. If this number were, let's say 25%, right, then it would be 6,500 times 4. Let's make sure that that's true and look that it is true, right? 6,500 times 4 is 26,000. So, but the actual that we use in the worksheet is 14%. Here's the point. We collect $46,000 worth of gross margin cash over the lifetime of their relationship with us, and we only spent $6,400 to get them in the first place. So what's LTV to CAC? It is lifetime value divided by customer acquisition cost. There we go, 7.2. Is that good? The answer is, because we want a happy spreadsheet, yes, it's fantastic. It's fantastic. What are benchmarks? David Skock, the godfather of SaaS, pioneered 3-to-1. You want this number to be 3 times what this number is. I like between 3 and 5-to-1, but what it's telling you what it's telling you is that the business is investable. That's the point. The point is, and one of the people I look up to is this guy Weston Gaddy. He's the general partner of Radiant Capital, and he says, growth is not a right. Growth is the privilege of companies with good unit economics, and that's what this ratio is articulating. It is a privilege to grow this much, and the privilege comes from customers liking your product enough and paying you enough that they stick around long enough that you can run the business with it. And now, when you see 7.2, first thing you say is that's great. The next thing you say is, can I spend a little bit more money to grow more quickly? And maybe I take this number down to 4 or 5, but I'm still doing well. This number goes below 3, you're in trouble. And if it's anywhere 2 or below, you basically don't have a subscription business at all. And we need to take another look.
Awesome, Sam. Thanks so much. A couple things that stood out that I'd love for you to dive a little bit deeper in. So as a marketer or a seller or somebody in the go-to-market teams, annual churn and gross percentage rates are not something you usually talk about a lot when you talk about marketing or selling. Those types of conversations don't come in. How can sales or marketing leaders really get a seat at the table when it comes to hey, talking about gross margin and churn, when in my experience those things are kind of like, just give me your budget and run with your budget, right? When those two levers are super impactful.
Well, I think this is where, we hear so much about revenue versus sales or marketing these days. Revenue operations as opposed to sales operations or marketing operations. I think that phrase revenue connotes what you're talking about, Taylor, which is that there's a growing recognition that all of these things are interconnected, and that it doesn't, again, what are we all coming to terms with? We're coming to terms with the reality that it doesn't do any good if I'm in a subscription business, like the fundamental assumptions underlying the whole thing, and by the whole thing I mean the whole startup economy, right? We got to understand why they're assumptions so that we can be sophisticated enough to have a seat at the table, right? So what are the assumptions? Well, we spend more than we make, we burn capital. Well, why do we do that? Why do we That doesn't make sense to most people. It doesn't make sense to my parents. Why would you spend more than you make? You spend more than you make because of what I just walked through, which is that in the out years, you're going to be paid back, but you need to have confidence about that. Okay, so what does that mean? That means that it doesn't do any good to acquire a customer if they don't stick around. That's what it means. So if you're a sales or marketing leader, you need to have a point of view. And I was literally, the first part of my day as we record this was in a board meeting, and we were showing retention by cohorts when people signed up for Pavilion. God bless you, Taylor. You're still a paying member. Don't ever cancel. But they were saying, we don't just want to see retention. We want to see LTV by cohort. We want to see are people behaving differently by when they sign up, and does that say something about your product? And even today, it 100% does. It 100% does. We had a sharp fall off in Pavilion in renewal cohorts from annual members that signed up in like the summer of 2021 that renewed in the summer of 2022, and the people that signed up for annual agreements in the fall of 2022 and renewed, or 2021 and renewed in 2022. Well, what changed? And it got worse. Well, what changed was that we got rid of local chapters, which we're realizing was a huge mistake. So we have to bring back chapters, meaning local communities, for you to feel plugged in to wherever you live, so that you don't feel like it's just one big global online university, but you actually feel like there's people in your city, in your town, that you can connect with, that you can form deep relationships with, right? That came out in the data. The point is, you want to sit at the table, you got to understand that you need to be looking at that, because again, we don't live in a world where it's hit the number at any cost anymore. You got to be selling customers that want to stay. And that is that's everybody working together. That's not just one department. That's not just sales or marketing. Sales can sell. I could promise you, listen, Taylor, if you join Pavilion, you're going to get promoted to CEO within 6 months. We're going to have Evian coming out of the faucets in your house. You're going to get a Rolls Royce, and you're going to win the lottery. And you're like, sign me up. Where do I sign up? And then 6 months comes and goes. You're like, well, that didn't happen the way that he said it would, and it wasn't really like that. And so you cancel. So the point is, like, we all The movement today is for, and that's really honestly like the point of Pavilion. One of the points, besides just helping you get where you want to go in your career, is educating on this subject. That
Mm,
here's how you're going to build a long-term business. If
mm,
you can have the confidence to build a long-term business, you're going to have career longevity and job security in a way that if you're just like, they handed me the budget, they told me to go hire 20 people, I got to go hire 20 people or else I'm not sure what to do, you will get fired. They
mm,
might get fired too, but you will get
mm,
fired. And that's
mm.
why it's so important that we all understand this stuff. What's the way to make sure to convince people that aren't on this same page? Maybe share the video of this recording. Third parties are typically the way to convince people if you're in some kind of emotional debate. But facts, figures, and data are the best way
Mm.
to have the conversation.
Super helpful. I love that. We get almost up on time here. Two more quick questions.
Yeah.
Um, a land and expand model in the sense of like, hey, we're going in with a smaller product and expanding later. How does that fit into your mindset in regards to unit economics?
It's works really, really well.
Okay.
And it can probably starting small and growing big is fantastic. You just got to look at the renewal cohort. Sometimes people think that they're going to start small and grow big, and then it turns out that that relationship is not quite as
Mm,
predictable as they want. The biggest mistake in general, right, that people make when it comes to so if you have, let me answer the question. If you have a good land and expand model and you can acquire that land cheaply and then expand more cheaply because it should be cheaper to expand than to acquire, you got a great business. And that's fantastic. And that's why, and not only do you have a great business, but you can spend more to acquire that
mm,
because on a per customer basis, it's cheaper and then expand, expand, expand. And that's why Snowflake computing was so highly valued because their expansion dynamics were so
mm,
powerful. So that's awesome. That's awesome. What's the mistake you're going to make? The mistake you're going to make, which we all make when it comes to an N of not big enough, is
mm,
that you're gonna think your business is more predictable than it actually is. That's
mm,
the mistake you're going to make, and you're being like, this cohort performed this way. That must mean that all people perform that way.
mm,
And the answer is no, not really. They don't all perform that way, and the economy is at play, and it's a dynamic state, and things are coming and going, and new competitors are entering the space. And so the point is I'm a huge believer in land and expand. Obviously, I'm a huge believer in anything that drives profitable growth. But I think you just got to be careful about not extrapolating small,
mm.
big trends from small sample sizes.
Love that. Thanks, Sam. We're up on time here. How can folks connect with you online?
You can find me on LinkedIn, but also, you can find me within the Pavilion Slack. Taylor's an executive member. If you're an executive member, you can ping me anytime you want. But I'm on LinkedIn, linkedin.com/the word in /Sam F. Jacobs.
Awesome, Sam. Thanks again for coming on. Really appreciate it.
Thanks for having me, Taylor.
Bye bye.